Hey everyone, welcome back to Corporate Decoder, the place where we decode the language of Wall Street. Today we're diving into an AMC Networks proxy statement, the kind of report that usually puts people to sleep. But don't worry, we'll wake you up with the interesting bits. Think boardroom battles and executive paychecks. It's all about who's getting what and how they're trying to keep their shareholders happy, or at least not too unhappy. First off, what is a proxy statement? Think of it as a cheat sheet for shareholders. It's got everything you need to know before you vote on important company matters, like who should be on the board or how much the top bosses get paid. Let's get into the highlights. The annual meeting is coming up in June. AMC wants you to dial in online to vote on some key decisions. They had a pretty solid year financially speaking. The big highlight, in 2024, AMC Networks generated $331 million in free cash flow, which is almost double what they made the year before. That's cash they can use to pay down debt, invest in new shows, or even return to shareholders. It tells a story of focusing on being profitable, cutting waste, and not only surviving in a tough media landscape, but actually thriving. Their streaming subscriber numbers also increased, hitting 12.4 million. That's an 8% jump from the previous year. In today's media world, subscriber growth is what Wall Street watches closely. They're also making some smart moves with content licensing, including a deal with Netflix to show some of their popular series. This means more revenue without having to spend extra money on marketing. Now, let's talk about who's running the show. This proxy statement wants you to vote on who should be on the board of directors. These are the folks who are in charge of making the big decisions at AMC. You have to vote for 13 people, 5 elected by one class of shares and 8 by another. The nominees include familiar names like Matthew Blank, former interim CEO, and several members of the Dolan family who have deep ties to the company's history. One thing to note, apparently a lot of shareholders weren't happy about Class A director Leonard Toe being nominated, and discussion ensued. The board decided to nominate him for re-election anyway, after discussion and careful consideration of his skills. What about paying the board? Well, each non-employee director gets $70,000 annually plus equity in the form of restricted stock units, valued at around $135,000. Moving on, there's a proposal to approve KPMG as their independent auditor. This is pretty standard stuff and the board recommends voting yes. A quick look at the fees paid to KPMG shows they spent $3 million on the audit. This is pretty standard for a company this size. Then there is the usual and exciting world of executive compensation. The board wants you to give them a thumbs up on how they're paying the top executives. The good news for AMC is that back in 2024, a whopping 91% of shareholders approved their executive compensation plan. Digging into the details, the executive compensation is heavily tied to performance. A big chunk, about 81% for the CEO and 70% for other top execs, is at risk, meaning it depends on how well the company does. The metrics they use to measure success are key financial targets like adjusted operating income or AOI and free cash flow. They are also looking at strategic goals such as company culture, audience engagement, and customer and partner experiences. There's also a vote to approve an amended and restated stock plan, essentially giving them more shares to use for employee compensation. This is how they attract, motivate, and retain talented employees. The company's 3-year average burn rate is about 3.97%. Burn rate is how quickly a company is using up its shares for compensation. This means the plan should cover their needs for about 3 years. Finally, and this is a big one, there's a proposal to move the company's incorporation from Delaware to Nevada. This is called redomestication. Why Nevada? Well, the company hopes for more predictable legal outcomes and lower franchise taxes, among other things. Nevada has a more statutory approach to corporate law, and they have clarified that the business judgment rule is the standard. Unlike the more complicated standards in Delaware courts, they are also hoping to reduce the risk of opportunistic litigation, saving time and money. So is AMC Networks on the right track? The numbers are solid, but it's crucial to see how they perform against those ambitious targets in the coming year. One last little nugget, the Dolan family, who are major shareholders, continue to hold a significant chunk of the company's voting power. Now, from my take, while it's great to see AMC focusing on profitability and subscriber growth, they need to keep delivering those quality shows that keep people hooked. I think their plan to move to Nevada is a bit of a gamble that will definitely need to be watched. Ultimately, it's a company with high debt in an industry going through a lot of transformation. So as long as there are profits, then there will always be light at the end of the tunnel. That's all for today's Corporate Decoder. Make sure to like, subscribe, and comment. Let me know what filings I should be digging into next.